If you're a physician, attorney, a high earning consultant, entrepreneur, anyone who's earning significant income as a 1099 contractor, there's a strategy that could let you move around $1 million into a Roth IRA in 5 years without dramatically increasing your tax bill. Now, your situation is likely not identical to the example that I'm going to use, but the goal of this video is to educate you on a concept that could potentially be applied to your own planning. The following are assumptions that I'm going to use in my example. 60 years old, income $500,000 per year as a 1099 contractor, and they plan to retire around 65. Their current assets are $1.5 million in pre-tax 401k or pre-tax IRA accounts, $100,000 in a Roth IRA, and $400,000 in a taxable brokerage account. After evaluating their own goals, it's quite simple. They want more Roth funds for tax-free growth, tax-free withdrawals, more flexibility in retirement, and also for the ability to leave their kids a significant non-taxable inheritance, which matters because they expect their children will inherit these funds during their own peak earning years. So the strategy that works for this individual has three components working together: a solo 401k, a cash balance pension plan, and Roth conversions. A cash balance pension plan is a type of defined benefit plan that at age 60 with $500,000 in income can allow for very large annual contributions. In some cases, over $200,000 per year, though the exact amount depends on your age, income, and actuarial calculations that are specific to your situation. The trade-off is that it requires hiring an actuary, has administrative costs, and requires consistent annual funding. If your income has any chance of dropping significantly in one of these 5 years, that funding requirement could become a real constraint. This added complexity makes it the right fit for some people and not the right fit for others. For this example, I'm going to assume that between the solo 401k and the cash balance plan, this person contributes and deducts an average of $200,000 per year over 5 years. That's $1 million in pre-tax retirement contributions and $1 million in tax deductions. Now, here's where your goals really determine the next step. Path A, you can simply take those deductions, reduce your taxes meaningfully each year for 5 years, and walk away with another $1 million in pre-tax retirement savings. That's a legitimate strategy, but here's the long-term picture in my example. You'd retire with roughly $2.5 to $3 million in pre-tax accounts, and while that sounds great, it comes with real trade-offs. Every dollar you eventually withdraw is taxed as ordinary income. Your required minimum distributions could push you into higher tax brackets, phase you out of credits and deductions, and increase your Medicare Part B and D premiums through IRMAA surcharges. And perhaps most importantly, you lose tax flexibility. You won't have the ability to choose which bucket to draw from in retirement. It helps having a pre-tax and a post-tax retirement bucket. So you could take path B, which is use the deductions to offset Roth conversions. Because this client's goal is building more Roth assets, this is the route that we'd consider. Each year, the $200,000 in plan contributions generates a $200,000 income deduction. We use that deduction to create room for Roth conversions. In a simplified sense, the deduction and the conversion roughly offset each other. Though in real planning strategies, we might take more than the deduction in conversions or less, depending on where the numbers lie when we project their future tax situation. But that is why I said earlier that you can keep your tax bill in a similar range with this strategy. That said, the exact impact depends on your marginal rate, how the deduction interacts with your QBI deduction, for example, and other factors, which is why running the actual numbers with an advisor matters. One additional note, when you do the Roth conversion, you want to pay the conversion taxes from your working income or your taxable brokerage account, not by withholding from the IRA itself. If you're under 59 and a half, any withholding for taxes from the IRA is going to have another 10% penalty. But the real reason is simple. Withholding from the IRA reduces the amount that eventually gets converted and ends up in the Roth. Every dollar withheld is a dollar that doesn't grow tax-free. You want the full conversion amount working for you in a tax-free Roth IRA. The ability to do this might depend on your personal cash flow situation and unrealized gains in your taxable brokerage account. Here's what this strategy does to the balance sheet over 5 years. The Roth account, as you can see, increases with net contributions around $1 million. The pre-tax account stays roughly the same as contributions and conversions net out in the example I'm using. And the taxable brokerage account either stays the same or decreases if it's used to pay conversion taxes. And one thing about a taxable brokerage account, dividends, interest, realized gains, those are taxable to you in the year that they happen. So this account has a leaky tax drag to it each year. So reducing a taxable brokerage account in order to increase a Roth can be a smart planning move. Now let me walk through one scenario that completely changes the math on this. If you currently live in a high income tax state, let's say New York, for example, or California, and you plan to move to a no income tax state, let's say Florida, when you retire, that changes the Roth conversion calculus significantly. If you convert now, you pay high New York or California income taxes on top of federal taxes. But if you wait and take distributions after you've moved to Florida, you pay zero state income taxes on those withdrawals. In that scenario, when we run the numbers, it often makes more sense to skip the Roth conversion layer entirely, take the pre-tax deductions now to avoid New York taxes, let the funds grow, and withdraw in a tax-free state in retirement. You'd still benefit from the solo 401k and the cash balance pension plan contributions, potentially still accumulating over $1 million in retirement savings in just 5 years. You just keep it in the pre-tax account rather than converting it to the Roth. And the same works the other way. If you live in Florida now, for example, and you're moving to New York, that's going to encourage the Roth conversions now even more so. The key takeaway here is where you live now and where you plan to live in retirement is one of the biggest variables in retirement tax planning. To recap this strategy, when the Roth conversion layer makes sense for your situation, can take someone from $100,000 in a Roth IRA to over $1.1 million in a Roth IRA in just 5 years, and the overall tax bill in a similar range year to year while they're working. The result is more tax-free assets, more flexibility in retirement. Conversions result in less exposure to RMDs or required minimum distributions, and a better inheritance picture for your kids. This video is not personalized investment or tax advice. It's for informational purposes only. If you're interested in a CFP professional looking at your personal situation, give Jonathan Retirement Solutions a call. Our number is on the screen. I hope you have a great day. Thank you for listening. And as always, money is a tool, knowledge is freedom, and planning is power.